Welcome everybody. On behalf of Colliers International, I'm really pleased that you could come today. My name is Walter Betcher. I work as Director of Research and Forecasting for Colliers International EMEA. I'm here with Demian, who's also a research colleague, and Demian Harrington. And we have our three capital markets guys from North America, Asia, and Europe, well introduced in due course.
The biggest risks in the U.S. market, I think, are really the same risks that exist globally, which are liquidity and interest rates, and how those effects, should our central banks begin to unwind, how those impact the real estate markets. But I think for the time being, I don't see that as really a short-term issue, but more of a long-term one. So again, I think 2015 looks to be a great year.
We are starting to see pockets of finance emerge across Europe, but in pockets. So it's happening now in the UK, it's happening in Germany and in Poland, and it's starting to filter into the Nordics and other markets. But there's still a few years left to run for the full deleveraging process to take place. That's likely to start to happen in Italy this year, to a degree again in Austria, and that's likely to have an impact on Central and Eastern Europe.
We're in uncharted waters now. We're 6.5 years into a recovery that was driven by excess liquidity. And we are at a point where 6.5 years in, we have no real material signs of inflation. And we are now sort of embarking in sort of these uncharted waters about where the market goes from here.
When you look at the three regions of the world, Europe or EMEA is the most attractive property cycle. There still is an element of distress in our market.
Europe is really recovering at multi-speed. We've seen the US recover far quicker. They're gateway cities, they're at prime peak levels.
Asia is very expensive, the governments are bringing in cooling measures to cool it down. So when you're trying to find real estate, which is a very attractive asset class compared to other asset classes, I think there's a lot of focus on Europe from around the world.
The problem that I see and the key risk that I see in the market is that we have too much money chasing too few assets. So consequently what we're seeing is balance sheet growth, balance sheet success, which is no success at all. What we want is productive assets to support another generation of economic development. Terence, what's the view from Asia?
Asia is kind of very different from what Ryan has said in the US. Asia is fortunate enough to have China opening up over the last 20 years. It has created and benefited from the opening up of China. I witnessed the growth of the huge economy from being the fifth largest economy rising up to the second largest economy within 5 years. Today we are seeing a reversal of roles where the capital coming out from Asia, China, going into Europe and US seeking for better opportunities.
We need to start thinking about alternative assets, alternative forms of real estate, and alternative forms of occupiers essentially.
There hasn't been much development over the last 4 or 5 years, hence a whole new generation of kit could be built sometime in the next 4 or 5 years, which will give institutions yet another chance to recycle their portfolios, to rebalance their portfolios, adding further life to the cycle.